Hey everybody, Lemonade's Q2 results just came out. We just had the letter, just absorbed the call. I'm going to be sharing some initial thoughts and analysis here in this video. And then in future videos, I'll be looking deeper, breaking things down, having a closer look, but doing a rough, quick initial overview in this video. And my impression that this was a very, very strong quarter of continued, I mean, I say this quarter after quarter, but continued execution from Lemonade team. The stock is up in pre-market. Oh, it's up just a little bit. It was up higher and bouncing all around high 30s to $40 range, but nothing, really crazy. We were at $40 and higher, not that long ago. So, that's where the stock price is at. I'm just going to look through some of my Twitter thread highlights here. So they beat on IFP, 1 billion, 83 million, 2.7 million customers. They're more customers than I expected. More customers than I was expecting. 148,000 customer growth. Quarter over quarter, so a huge amount of customer growth. I think they beat on customer count significantly, and I think that in large part that's probably due to the European expansion. They're really growing the European segment aggressively. I think the letter said they're growing. Where did it say that the European segment was growing? Yeah. They now have over 250,000 renters, homeowners in Europe. So my guess, and they're growing, if you look at IFP growth rates in Europe, they're 43 million right now of IFP. It wasn't even that long ago. They had like 12 million, 14 million total. So they grew 10 million just in the last quarter. So they're really pushing and expanding that customer base in Europe. Some of those are going to be homeowners. Actually curious to see right now. Looking down at the premium per customer for Europe, it's only $168. So most of these customers in Europe are going to be renters customers that are in some ways probably easier to acquire for Lemonade when they have a much better product than the market has in a sort of unloved product group. And so that's why I think they're beating on this. Your premium customer is still growing slightly, but your customer base, total customers are growing significantly, and you have that sort of that higher beat than I was expecting in your total customer count. Their IFP beat, 1 billion 83 million, like I mentioned, versus a guide of, they beat the guide by the better end of their guide by 19 million. So that's really significant, actually. Top line beat there. Loss ratios not quite as good as I was hoping, but still really good. 67% gross loss ratio and 70% then on a trailing 12 months, and your car loss ratio is 82%. So back to where it was 2 quarters ago was 83%. Now we're at 82%. It's still, I think we're going to see car really become, with their telematics that they have, that is probably already one of the best in the industry and only going to get better. I think we're going to see this drop down to, in range probably with where pet is, or it's 70% or maybe even better than that, longer. And overall their top line is accelerating in growth. The growth rate of that is accelerating while the loss ratio is improving. This is all over the last, couple years here. Really impressive. And if you look at operating expenses excluding growth spend, it actually dropped from 87 million, or even the quarter prior. It dropped down just a hair. And there was a one-time benefit of 11.7 million. Hold on here. That made that look better than it really was, but it's sort of a marginal increase quarter over quarter in this. All your operating expenses excluding your growth spend. Of course, your growth spend is rapidly growing. Car is growing as well. It's similar to that Europe graph that we saw in the letter there, but car is IFP's accelerating up. It's been basically levels they've probably been tinkering, experimenting, removing worst car customers, slowly, very carefully expanding. Now we're going to finally start to see this accelerate. It's only still 22% year over year growth, which you think about, the whole business grew 29%. So we should really see these bars start to jump in future quarters. I mean, the goal is, as they 10x their book of business, is to grow from this $150 million of car right now to something like maybe $4 billion of car out of $10 billion of the whole book. So it's going to grow a really significant amount in the coming quarters. That will be, I think, the huge wake-up call we're seeing effects of it now, and there's sort of mixed positive, negative effects, from non-renewals, but positive effects from car and car loss ratios improving. But as car loss ratio improves more and as they scale it more dramatically, we're really going to see the effect of that in your unit economics and across, it's going to touch on the financials across the board as we look at Lemonade. And this graph I pulled up in the letter, but Europe is really accelerating. Reinsurance, I mentioned this because there was some debate in the Lemonade community that whether reinsurance just drops off a cliff from 55 to 20% ceded, but it's going to go gradually over the next several quarters. They said from 55 to 20, and guidance did increase a little bit, not a dramatic amount. I'll have to look at these numbers a little bit closer, but not increased. Cash investments rose rose up to, I think, the highest level it's been in the last year, and $1.032 billion. Adjusted EBITDA was $40 million. Actually, I mentioned this down below here. If they had some, let me look it down here and then zip back. Adjusted EBITDA, if they hadn't had this reconciliation here, there was this one-time refund actually made the adjusted EBITDA look worse. So if they didn't have that, subtracting out of your adjusted EBITDA, you would have had more like a $29 million adjusted EBITDA, which roughly what I was expecting in my preview for the quarter. So that was, but still, solid there. And your growth rate of your customers, if you look at that we're close to 150,000 customers gained that quarter. So really significant. And, if anything, Q3 has typically been their highest. So maybe we'll see even higher sort of dynamic of that here. Q3. All of these bars are Q3. Then we had period of much lower growth. We had Q3 again, Q3, and probably next quarter, Q3 will be higher yet once again. And annual dollar retention was 84%. And this is again lower if we look at annual dollar retention here. We were as high as 88% for a few quarters, and we're 87%, and now last 2 quarters have been 84%. I expect this is mostly due to the home non-renewals, and I think as that happened a year ago, because annual dollar retention looks at the customers a year ago and says how's that cohort of the book of business a year ago doing now. And as those customers from a year ago that were getting non-renewed, all that finishes, then we're going to see annual dollar retention rise. And then as car rolls out, we'll really see annual dollar retention rise. I only have it modeled, but in the low 90% range. It all depends sort of how your policies per customers roll out, what that cross-sell rate looks like as more people bundle products. But I wouldn't be surprised if this, even went higher, was like high 90s or even 100% in the next couple of years as car ramps. Because car, going back to that graph of car, car is still really tiny, only $150 million to IFP, and it's only still growing 22% year over year. So we're really going to see this spike of how this grows. Okay, back to where we were. We touched on net customer annual dollar retention. We looked at that. Churn, customer churn is something I calculate, and is of 17.5%. And I think we will see this go back down to more, around 16% range as those home non-renewals are taken care of, and they stop comparing, because this is a 12-month comparison again. And so once that comparison's done, you'll see that. This was interesting. Yeah, operating expenses other than your sales and marketing, which is large growth increase because of the growth spend increase. But other than that, your other insurance expenses were down 18% quarter over quarter. Tech development was completely flat, 2% change. General administrative down 28% quarter over quarter. These are some of these, like G&A, tech, especially G&A and other, I feel like they can sort of jump around a fair amount even quarter to quarter. So it's a bit tough to sort of predict those, but it left your total operating expenses, even with a huge increase in growth spend, only increasing by about $3 million. So really, really impressive that some of these line items are dropping. And yeah, I talked about the adjusted EBITDA. If you had made that one-time adjustment, $11.7 million, then we would have been at more like a $29 million loss for the quarter. So I might just jump over to my model. It might be easier to see some of these things here. So hold up here. Let's jump over to my model here. Again, this Lemonade model. If you're just joining or following my channel, you can find this on my Patreon. So feel free to join that Patreon. It's only $5 a month, and you can get full access to this, as I'll continue to update it over time. So I'm just going to flip through things and make comments here. If you look at LTV to CAC, lifetime value of a customer versus their customer acquisition cost, it was 3.1 in Q2. As annual dollar, this is an estimate, and I based this estimate off this calculation right here under my side math. And depending on the values you put in, these are just, you can punch in whatever values you want here, but whatever sort of values you assume for, a customer's annual dollar retention, the cost of capital over time, their customer acquisition costs, which I do calculate, then you can punch in and get an LTV and an LTV to CAC ratio. And so this LTV to CAC, I'm just simply putting in kind of the surface level numbers that are presented on each quarter, and it gives you that quarter by quarter basis to see, hey, for every dollar they're spending on growth spend, what's the gross profits they're going to achieve. So a healthy range there of over 3.1. Maybe a better way, probably a better metric in a way, is looking at it for trailing 12 months. And then you can see you have a little more consistent, evened out, smooth lines, and you're still at 3.2, still over 3 for this figure. LTV, and I mentioned this in my thread there on Twitter, but I think LTV to CAC is going to rise. We're right here, 3.2 on a trailing 12-month basis. I really expect, as CAR dramatically rolls out, pushes out, this could, I don't know exactly what it's going to look like, but I think this is going to rise more into like 4 or 5, even 6 range, 4 to 6 range, as you have CAR on the book of business, because CAR is just such a significant product. Let's just go flip and look at that supplementary thing here for a moment. So if you look at premium, if you look at premium per customer for CAR, continues to rise. You're at almost $1,900 per customer, and if you look at home is maybe, is maybe a couple $1,000s of home, but renters is, maybe 100. And I actually have that in my model down here, an estimate for what renters premium per customer might be. It might be, might be $168. Actually, it might even be, I'll have to make an adjustment on that because Europe would probably have a little bit of home, but it might be, in that range. So your premium per customer for some of their product lines is really low compared to their premium per customer for CAR. So as you roll out CAR, you literally can 10x somebody's premiums if they're a renter, and then they switch their car over to you, they could literally 10x that person's premium. So that's how then that you think about the sort of potential value of what you're spending to acquire that renter's customer versus the value you're going to get from them over their whole lifetime, discounted back to today. It's it's a really significant impact as CAR rolls out. CAR is a big deal. Okay, IFP from a historical, you can see a graph of IFP here. Total customers is here. You can see we talked about this a little bit, net customer growth. Again, Q3 would probably be even higher, especially maybe they continue to really push customer growth in Europe. And premium per customer has been trickling upwards again as CAR is really rolled out. We're going to see this pop and rise a lot faster. Gross loss ratio on a trailing 12 months, it gives you a nicer sort of longer term picture all the way back to like 20, even before they IPO'd, where they had very high loss ratios, tiny book of business, and now that has gone. They had a period of heavy inflation, home that was probably rolled out too aggressively, and had an elevated loss ratio. Now we've seen that nicely trend down. I'm going to look at this. I shared this on my Twitter thread as well, but the present value of all customers, meaning what I do is I take that estimate of your the lifetime value of your customers multiplied by the total customers. You kind of get hey, what's the value of all our customers? And I have that. You can see a nice pop here as your customers' growth increases and your LTV per customer increases. So it's an estimate, of course, and here's a projection of maybe where that's sort of headed in over the next number of years out into the 2030s. That's going to we're right here, it's tiny here, right here. That's going to really accelerate as all your customer base grows. And again, as CAR rolls out, all the suite of products rolls out, you're getting more premium per product, per customer, and you have, strong loss ratios across the board. You're going to have strong annual dollar retention across the board. You're going to have really strong, this sort of trend. It's not anything that Lemonade would release, but it tells us something about where things are headed, below, sort of beneath the surface more. They're spending a lot of money on growth, $49 million. They reiterated on the call. I heard them say they're expecting like $170 million of growth. So they're spending a lot on growth. This, hold up here. I like the ones that here. I'll flip to this one. This is a graph. It shows, first of all, your growth spend in blue. So you're spending a lot again on your marketing, on advertising, all that kind of stuff. And your pink bars here show how much, if you spend $1 on growth spend, how many dollars of IFP are you acquiring? This is not like a net change of IFP. This is acquired IFP, because there's dollars that are coming in, and then there's dollars that are leaving because customers maybe churn away or are non-renewed. So that dampens and hurts this metric. But this pink bar is again looking at what's the dollars that are being acquired, what's coming in the door for Lemonade. And you can see that it was at 2.37 over 2.74. Now, as you spend more and more on growth spend on advertising, then each subsequent dollar you spend is less efficient than the last one. So this hurts your efficiency here. So you're spending a lot less in these quarters, but you're really efficient because you're spending a lot less. Now, as CAR rolls out, how many times have I said, as CAR rolls out more aggressively? As CAR rolls out more aggressively, I'm going to say it a few more times. As CAR rolls out more aggressively, we should see this improve. And also, Tim mentioned on the call that they're doing more brand, sort of overall brand advertising, billboards, those kind of things, those campaigns. So you spend more dollars up front now, And then you should sort of see that the benefits of that, the dollars you spend, a little bit later on, as people just remember the brand, remember the product later, and you're more easily able to get those customers and acquire that later on. So yeah, adjusted EBITDA. You can look at adjusted EBITDA on a quarterly basis here. Shows how that's continuing to trend in the right direction. If you look at adjusted EBITDA minus growth spend, so if you subtract out the growth spend, they were positive here. Now, if you had that 11.7 million adjustment back, you'd actually be quite a bit higher. I could even just pop that in, just say adjusted EBITDA is, give me a second here. So I'll just say equals minus 40.9 plus 11.7. Yeah, so we threw that in there. Now you're 29, and boop, you just see it actually popped up that amount. So you're following this same trend line exactly upwards. I might need to post that on Twitter because that's a nice visual there. We'll flip that back, though, to what is actually reported. And adjusted EBITDA trailing 12 months is here. And again, we'll continue to improve. If you look at adjusted EBITDA as a ratio to gross earned premiums, it's continuing to trend towards break even, and will cross somewhere in 2026. Customer churn, we touched on that, was 17%, but I think we'll improve. Annual dollar retention, again, I think will bump back up even and go higher than it's ever been. This was a graph of the marketing efficiency for the quarter, that same ratio that we looked at of CAC spend to IFP acquired you're getting, and the quarter was over here. So it's different, interesting. Like your trend line kind of across is this range, and then the difference between the trend line and where we are is a little bit above. And I think that sort of difference in the trend line, even as they continue to spend in this higher, $50 million range for the quarter, or $40 to $50 million range, we'll see dots appearing somewhere, I think, up between where it is now, or even higher than that, sort of the high 2 range in that ratio. Policies per customer. So I just added this into my model the other day, the latest version of my model here. This is an important thing I will be tracking because they give us this whole nice supplement here. You can figure out how many policies in that versus how many customers. And you can see this is starting to rise, and your policies per customer, again, as CAR rolls out, policies per customer is going to just, I think, continue to climb. And just another way we can look at it and observe what's happening in the business, and that, your cross-sell bundling is continuing to take off. So the cost they paid per customer was about $205 million dollars per customer. That's what they're spending. This is still really significant versus a lot of what I understand. It's not totally cut and dry, clear release by other insurers. I mean, Lemonade doesn't even release this. I calculate this, but I understand, a lot of insurers might spend $500 up to, $900 on a customer to acquire them because they're only competing in sort of, in the more competitive markets like car. If you look at OpEx minus growth spend, we were 85 million. If you add in that 11 million or 11 million adjustment, we're just above, where this sort of, you can see there's fairly consistent trend of a couple, looks like maybe about 3 million a quarter or so is being added to your overall operating expenses minus growth spend. If you look at total operating expenses, this includes sales and marketing now, includes growth spend, all of that. We were basically flat, as I pointed out earlier, for the quarter, even though your top line is growing. It's because you had in the other OpEx lines, you had some nice improvements. Let's see there. We don't have. I wish I knew how much employees level was at. We'll have to see. I don't know if that was released somewhere in the call, and I missed that. I don't recall that being shared, but this will be nice to see an update on your IFP per employee will continue to, I expect, continue to rise. My guess is they really had very little, customer change. In fact, if I put that in, let's just say, hold up here. Let's say, you say it was exact same customer change. Maybe I'll highlight that so you can remember to update that later. Then, your IFP per employee continues to march upwards of, 859,000. And that's what I expect. And your customers per employee also would continue to rise. So expect that. Cash was, again, very strong. Surplus, and Tim mentioned on the call that they really don't see any difference in sort of the overall ratio of capital needs to, underwriting needs. They don't, you can tell they're kind of, they're a little bit uncertain they're a little bit hesitant to say too strongly that ratio, but he says still around a 6-to-1 ratio. I'm sure there's more nuance to that ratio than what they, are just sharing with that single number. But to me, that tells me, they really won't need to raise capital. Some people made the claim that when they did the reinsurance change that they're definitely going to need to raise capital because their capital requirements are going to be more stringent. But it was interesting that they were able to lower the reinsurance to the extent they did, but even not be changing their surplus. Actually, I haven't even updated the ratio in this model yet, so this might be if anything, this surplus might be better than what we're showing here. But overall, man, I thought, wow, what else can I say? I thought a really, really good quarter. Let's see what the stock is doing right now. Now we're climbing $41 back up to there. So market seems to see this as a strong quarter. I certainly see this as a strong quarter. Another thing I'll comment on, I tweeted about in the Lemonade community, was the loss adjustment expense. Loss adjustment expense, so that's sort of your portion of your loss ratio that is used for administering claims. So if you have a 67% loss ratio and 7% is used as a loss adjustment expense. So it's 7 out of your 67% of what you're paying out in claims is actually just paid in adjudicating those claims, checking on claims, accounting for fraud, helping, assisting people in their claims. So they're only 7%. That is wildly efficient, especially given that they're only a billion, 1.08 billion dollar company. So as this scales to 10 billion or even, beyond that, this will probably get even better. But I think this already, it would be, rival or be better than some of the very biggest insurers in the world. So this just shows they're driving down the costs that they can, that are inside of their business. So, man, I will be sharing lots more in future videos, but I just want to get this one out to you guys. And I think it was a fantastic quarter, super exciting times to be a Lemonade investor. Let me know what you thought down below in the comments. Thank you so much for watching. Remember, it's in the bag.